Welcome to Life Planning 101, brought to you by Smart Money Group and Kennedy Financial Services in Eastland, Texas. Tune in every week as we share important information to help you and your family live life on purpose. Insurance, investments, legacy and tax planning, and much more. All covered now on Life Planning 101.
Hello everybody, this is Samuel Barker here with Aaron Kennedy again today. We're going to take a look at what's going on internationally and talk a little bit about about currencies. We had a job report come out. Aaron, give us the lowdown.
Yes, hey. And I thought we'd have a little bit of fun and talk about something a little bit different. It all works together, but hearing a lot of stuff right now about how the U.S. dollar is going to crater, and this is the end of the times for U.S. dollar, and I kind of want to dig into it a little bit. I think it'll be fun. Hopefully, I don't know if we're going to be raising fears or lowering them, but let's talk about it.
Yeah.
You know, say what is really going on, and we've mentioned it a little bit when we're looking at international. Any U.S. dollar that's not in a U.S. bank here on U.S. soil is a euro dollar. So don't be confused with euros. These are just international dollars. And there's some pros and cons to euro dollars. Once they leave the U.S., no more regulation, or very, very little. FDIC insurance, nobody's paying for that overseas. Not nobody, but it's not being paid for, so you don't get quite the insurance.
And essentially, it's just U.S. dollars in foreign banks.
Yes, yeah. And it's the other thing is unregulated. I think you were looking it up earlier. The U.S. quit even reporting what's out there back in 2006.
Yeah. The reason is that the derivatives market, being futures and whatever swaps, they just got so outrageous that it was a useless measurement because it doesn't accurately reflect what's actually going on.
So what is that scary or what? We have no idea how many dollars are out there. The last, as we were digging around, and the last even attempted number was, I believe, 2022, and there's about almost $45 trillion out there. And how this kind of came to be was Bretton Woods. Back in the day, we made a deal with Saudi Arabia, and it was, hey, if you sell your barrels of oil in U.S. dollars, then we'll trade you some fancy weapons and ammunition and everything else. And they agreed. So anybody, whether you're in France, China, South Africa, or Argentina, if you want to buy oil on the global market, you have to sell your home currency, buy U.S. dollars, and then purchase your oil. So you can imagine how powerful this was for the United States. This was a game changer. And we know that the U.S. dollar, it's the world currency. Most people trade in U.S. dollars.
And it was Bretton Woods that did that, correct? Right after, it was a resolution after World War II. Is that correct?
Yes.
Yeah.
There's right in there.
Yeah, 1944, which is about the same year that Donald Trump and Joe Biden were born. So.
just to kind of give you, I saw some cool numbers. See how fast this took off. From 1964 to 1969. The euro-dollar market grew from $75 billion to $264 billion. 5 years. And then after that, now we're in the 44, almost $45 trillion. And the strange thing is it's weakening. There's still a huge amount of demand for U.S. dollars. All countries are going to be trading, and they need those U.S. dollars to make those trades, but they're drying up. The market is not really being, funded with U.S. dollars. You just think about here in our economy. We used to buy every barrel of oil in the global market, so we were flooding the market with U.S. dollars to buy that oil and bring it back in. So these countries had a huge amount of dollars to play with. Natural gas, the same way. We've always been in a trade deficit, so any amount of trade that we do, we're going to be shipping dollars or selling dollars to buy other currencies on a lot larger scale than the other way around. But what's happened here recently is our oil industry, the fracking, the technology, the horizontal drilling, we're not buying the oil. We're actually shipping oil. We're shipping natural gas. And it is sucking the euro dollars right out of the market. So it's pretty incredible.
So and just to kind of break it down, because it takes me a second to wrap my head around it, whenever we are importing things from Japan, cars, oil and gas, things like that, we're essentially exchanging those items for U.S. dollars, and that's what creates the euro dollar. And then now that we are a net producer of oil and gas, they're giving us those dollars back in exchange for the oil and gas that we're now producing.
Yes.
Okay. And so whenever we, let's say that we continue to overproduce, and I say overproduce relative to what we used to, we're going to continue sucking those euro dollars back into the United States, reducing the total amount of euro dollars that are in existence.
Yes, that's exactly right.
And so so I'm looking at a chart here. In the 1940s, interest rates were relatively low. And then from about 1950 in through the 1980s, it was extremely volatile, but interest rates went from under 2.5 to, in the peaks of the 1980s, over 15. Does the euro dollar have any influence over the interest rates, or what does that look like? Because I know as interest rates change, the dollar gets stronger. Do you know what the euro dollar has in terms of effects on our local interest rates?
On the local? Boy, that is a great question. It is part of the problem. When we have a larger interest rate than another country, our U.S. dollar is supposed to be risk-free. So that's a huge amount of trade, is selling a local currency and buying the U.S. dollar and getting that huge interest rate, which is right now it's huge compared to the rest of the world. But historically, as interest rates go up, more people come over to the U.S. dollar to get that risk-free interest rate. Now, what happens to that money after they buy it, that's where the euro dollar goes. If you bring it into your bank in another country, it matures, going to mature in dollars, and then it's gone. You can use those dollars to buy even more, or you can use your local currency to buy even more. So I would think it would increase demand as interest rates go up relative to what the local currency is.
Yeah. And so taking it a step further, whenever we are buying oil and gas and other items overseas, we're flooding the market with the euro dollars. A lot of the times they're turning around and buying treasury bills, correct? And then those treasury bills, especially right now with the higher interest rates, we're sending additional dollars in interest to those treasury bills.
Yes.
So there's always a back and forth on what's creating and taking away the existence of the euro dollar.
Yes, that's exactly right. If the way the world worked, every year we were putting more and more dollars into the system. And the big fear is what happens when that changes. Funny thing is, I don't think anything is going to be a sudden change in the way the world works. Funny thing about currency is it's all relative. So when we're starting to talk about the death of the U.S. dollar, what are people going to trade in? If it's relative, can the dollar really fall compared to the Japanese yen and the euro and the yuan? You think about all these countries, and we would have to have like a Greece event or something like that for us to fall against all of them at one time. I'm not saying that can't happen, but I think the odds, if you've kind of been watching what the global scene has been, is everybody's doing the same thing. We are too global of an economy to have one major power or major country decouple from the rest. You might have some time frames where things are a little bit different. Germany's increasing interest rates while the U.S. is lowering, or we just saw Japan doing that. We can see some temporary things, but most of the time when the global economy's hot, everybody's trying to slow down their inflation figures, and just the same way when the economy is crawling or we're going into a recession, everybody's flooding the market at the same time.
Is 2008 a good example of how globalized we are? Because my understanding is 2008 was essentially triggered here locally in the housing market, and it spread throughout the world as a result of kind of the globalization and leverage that was in the world.
Yes, there's only so many things that people can invest in. You know, if you're a sovereign wealth fund, let's say you're a manager for all the money in Saudi Arabia's sovereign wealth fund, and you know they got $100 billion they need to go invest. Where are you going to dump that? You know, what can handle that kind of purchase? And it's been, you go to the largest economies. You know, the U.S., the almighty United States of America has been a huge place to invest because it can handle it. You look at companies now like NVIDIA and Microsoft and Apple. These are bigger than entire countries' GDP. So the USA has had a blessing of lots of international money coming in to invest in our assets. So we've been pretty lucky. But you know, when we're going back to that relativity of the currency, who goes up and who goes down and why? There's been a lot of turmoil here lately. A lot of it's around Russia, the Ukraine war. We saw something happen, and that was the U.S. would go out and confiscate assets from different individuals in different countries and banks. And it scared a lot of people, a lot of countries. And they decided that maybe the U.S. dollar really isn't the safest place to invest, especially if someone could come and take it away from you. So, you know, we started to see cracks from that. It actually started a little bit earlier, but the good old-fashioned BRICS nations, which is Brazil, Russia, India, China, and
South
Africa, they decided that they wanted to put together a currency that they could trade amongst themselves that was absent the U.S. dollar. That's fine and dandy. You know, you can trade with brothers and sisters and families and cousins and nothing happens. You can all do it by a handshake. But for this to be a global currency that people would be willing to put their assets in and be safe, that's another matter. Who's going to believe any of those countries?
Yeah.
You know, who's going to feel that the Russian ruble is safe or the Chinese yuan? Who's going to feel that's safe? And we started seeing these countries say, hey, I can safen up my currency by buying gold. And we've seen records amount of gold being bought. Who knows the reasons? It could be diversification. You could be trying to just make your country's currency safer, you know. But regardless of the reason, lots and lots of gold has been bought. 483 tons were bought first half of this year, and that broke the record of half a season of 2023. They'd bought 460, and it just keeps growing and growing and growing. And this is just, it's a safety measure. It's either making sure you have something backing up your currency other than the U.S. dollar, or safening your dollar so you can compete with the U.S. dollar.
And we didn't prepare for this, so I'm throwing you a curveball a little bit here. What was, I guess, the United States balance sheet prior to the world wars was pretty full of gold and security through gold. And then we went to go lend a lot of that to the European countries that needed it through those wars. Is that any insight into what's looking forward? I know there's been a lot of talk about, you know, risks around the world of war and different things like that. So you said it's a safety measure. Could it be just a financial safety measure? Is it just an overall safety measure against anything that could happen? And then, you know, are we looking at maybe somebody preparing their balance sheet to be a liquidity source during times of terrible times?
And I think it's mostly just financial safety. If a country's going to be trading with another country and we're putting money down on deposit, or we know we're going to be receiving, let's just say I'm making a trade or doing some trade with Japan, and I know I'm going to be receiving all this yen. I make my deal, and I know 6 months from now I'm going to be getting all this yen. If there's a high probability that that yen depreciates, or it is so volatile we don't know if it's going to be up or down, I'm probably going to charge more for that asset just to make sure I get what I need.
Yeah.
The safer your currency is and the less volatile it is, the more valuable it's going to be for trade. And if your currency is backed by gold, nobody's really going to worry that you're going to default. You know, hey, if you do default, I'll come get your gold and everything's good. So trade is easier, you get better terms, the world just works smoother. And these countries, that's what they're trying to do. They're trying to safen up their balance sheet. They're trying to make sure all the money that they have in their treasury is safe and sound. And that's what we're seeing. And they're buying it hand over fist. Because really, if we go back to the BRICS nations, there was some other countries that jumped in on this, let's say Egypt, Ethiopia, Iran, Saudi Arabia, UAE. There's been several of them. But which one of those countries are you going to trade with in their currency? You feel safe about going to Ethiopia and dropping a couple $1 billion? Or Iran? How's that work?
Well, and are they competing with each other at the same time? So I don't think, I think the Chinese yuan has come out as kind of stronger than the rest. But are they going to be competing amongst each other, with each other, to figure out which one of their currencies is going to be the primary currency of the BRICS nations? Or?
Yeah, that's a great question. They're basically just sharing the load right now, trading within their own currencies. But I think the overall goal is to have one central currency, and I don't know if it's going to be China. More than likely, that's the larger economy that can handle the size. So if it is an individual country, it more than likely will be China, and that's their goal. They want to be the global powerhouse. They want to be the global world reserve, and they've got to get to a place where they're being trusted, and people believe the numbers that they're giving out, because it hasn't been that way. Not in my lifetime.
Yeah. Well, and it definitely wasn't. You could never trust the numbers that came during the COVID pandemic, and so it's
right.
There's a lot of trust to be gained there.
Yes, lots of trust. But if you just look at it from a big picture standpoint, it's absolutely fascinating how the global finance system works, and how much reliance there is on the U.S. dollar, and this absolute belief that the U.S. dollar is a risk-free currency. And once you start to see cracks in that, nothing really matters from a financial standpoint. It's going to be all psychological. So once the cracks start, they're not going to slow down. And a lot of these countries are going to be just looking for a safer way to do it. And I don't see the U.S. dollar, this huge demise that we drop 75% or 50%. We just should be more on average with the rest of the countries, and we may drop 10 to 15%. But when is this? This is 2030, 2035, probably 2050. This isn't going to be something that happens overnight. It's just going to unwind slowly, as long as there's no 2008 event.
Yeah.
But all of it, it doesn't matter how slow it is, or if it happens at all, it's not going to be very positive for us. Because if our dollar weakens, that means we're going to have to be paying more for any amount of trade. So our household goods that we're buying from Japan or Temu or any of those things are just going to get more expensive. So we've been very lucky as citizens of this country by having the U.S. dollar as the global reserve.
Really quick, you had said something earlier about, it's all relative when you're talking currencies. And then, you have to have trust in the currency. The more volatile, the less trust you can have in it. It's kind of like, have you ever considered, and I heard this on a podcast a few weeks ago, if you look at Bitcoin, the price volatility of Bitcoin is insane. And so, if it's worth $68,000 today, but a year from now might be worth $16,000 as it was in 2023, 2022, you
Right.
know, you just bought a 68,000 Bitcoin car, and now, look what you've done. So whenever you're thinking relative, whenever we are doing international trade, if we are going out and the dollar is weakening, we're able to buy less internationally, and we're talking now relative. That means everybody else internationally is getting less e-commerce from the United States. So economically, they're doing worse as well. And so that's going to hurt their economies. Is that right? So that's kind of how the globalization effect happens.
Yeah, that's a way to think about it for sure. Everything is interconnected at this point. And if we sneeze, someone in Europe's going to catch a cold.
Yeah.
We are that intertwined. We are that intertwined, but, you go back and look at our different markets and see how different. It's a very strange dynamic. Go look at Europe and the companies there, and you're looking at old economy versus U.S. is more technologically driven. But even though there's differences in what we do and what we own and who lives here, we are, from an economic standpoint, we're all going in the same direction.
Yeah.
Pretty fascinating.
Well, do we have anything else on the agenda today, or?
Let's see here. Got some jobs reports out today. We're really scratching our head on this. Don't know what in the world's going on. Market really liked it. Unemployment dropped down to 4.1, so that's great. Lots of jobs were created, a lot more than we thought. But what's so confusing is we went to the Bureau of Labor Statistics, and it looks like government jobs increased by about 785,000.
And the total job growth was only 250 something thousand.
Yes. So we're trying to dig into this of what exactly they're saying. Don't want to say, hey, they're trying to make the economy look good right before an election, but something's fishy. But the market liked it.
Yeah.
So I'm liking it today.
Yeah. It looks good for now.
It looks beautiful today. So going to end off with a decent week. We've had a great run over the last month. Hopefully we can keep this up. We're getting pretty close to the Santa Claus rally. Everybody's going to be excited about Christmas and spending on Amazon. And usually this is the strongest part of the market from about the end of October through January. So I know we got something pretty big happening here in the U.S. Got a big election, so that can throw a kink into it. But it's not starting out too bad.
Yeah. Well, and I think they just said that the strike has been
Yes.
extended. Well, the strike is over at least until January, I think is what they said. So
what did they get? Like it's over a 65% pay raise.
they're asking for a lot. I haven't looked into it, but I know it's ridiculous. So anyways, if that gets us taken care of, I appreciate you all meeting together with us. Thank you for taking the time, Aaron. And that's going to do it for us today on Black and White Market Minute with Life Planning 101.
Thank you for joining us for Life Planning 101, brought to you by Smart Money Group and Kennedy Financial Services. If you have questions, you can email them to lifeplanning@kennedy-financial.com. Be sure to tune in next week for more Life Planning 101. The opinions expressed herein are those of the firm and are subject to change without notice. The opinions referenced are as of the date of publication and are subject to change due to changes in the market or economic conditions and may not necessarily come to pass. Any opinions, projections, or forward-looking statements expressed herein are solely those of the author, may differ from the views or opinions expressed by other areas of the firm, and are only for general informational purposes as of the date indicated. Securities offered through Calton & Associates Incorporated, a registered investment advisor, member FINRA SIPC. Investment advisory services offered through Smart Money Group LLC. Kennedy Financial Services and Smart Money Group LLC are separate entities and are not owned or controlled by Calton & Associates Incorporated.